let's take a step back when it comes to Basel III and look at what prompted new regulations to come to the fore. It's really about the systemic risks that we saw during the financial crisis, and of course bailout after bailout when it came to developed world banks as well. Your view on the most recent developments when it comes to the regulatory environment?
Yeah, good afternoon. Thank you very much. Certainly a very hot topic right now, given what's happened with the crisis, and governments and central banks having to bail out the banking system in many countries across the world. Of course, I think we need to go back a bit. Basel III is not new. The whole rewrite of the capital adequacy rules started way back in the early 2000s, I think around about 2001, 2002. And at that time, there was the so-called Basel II set of rules, which eventually was implemented January 2008. Not by all countries in the world, but countries like South Africa, European countries, big banks in the US, Australia, etc., implemented the Basel II rules at a time. Now, the Basel II rules were aimed at really adjusting the capital in the system to be more sensitive. So, the banks are adequately capitalized for the risk that they face. But as we now know, what happened during the financial crisis actually proved that there were fundamental flaws in the whole Basel II regime. It did not really protect the system. There was a lot of criticism. And in many cases, we believe that Basel II actually aggravated the crisis to an extent. Since the crisis started, somehow things got back to a stable situation. 2008, the international regulators then started drafting the new Basel III rules, which currently under discussion. Were quite dramatic set of rules that will come in towards the end of 2012.
Well, just, Frank, if we could include you in this conversation, just looking at the liquidity ratios that we're expecting to see from Basel III. We know that it is all about capital adequacy ratios at this point in time and ensuring that banks are well capitalized. And as opposed to lending even more money out, it's about having enough capital in its coffers and, of course, being relatively prudent when it comes to lending. Do you agree with the propositions that have been put on the table thus far when it comes to regulations?
I think they are necessary changes that have to be made. A few things came to nature. You mentioned the systematic nature of the banking system, the interconnectedness. We saw how what played out in that sphere in 2008 with one bank affecting the liquidity of the next bank and so forth. Liquidity problems were definitely an issue. So what happened was people would tighten their capital and keep it at home to cover these conditions that prevailed then in the market, didn't lend the money out, and so that filtered then through to the real sector of the economy. Leverage leverage was never a variable that people watched. They watched capital requirements, they watched economic capital, etc. This is a new thing that they want to bring in. So I think that will only strengthen the Basel Accord. There's one more thing here maybe, and that's the pro-cyclicality of everything. So in good periods, you tend to lend out even more money because things are going well. Which is pro-cyclical. We want to change that and go counter-cyclical in a way. So in the good times, keep a reserve for the bad times.
Okay, Andre, well, just looking at the impact that it's going to have on African banks, we know that South African banks have been very well capitalized, and this is why we went through the crisis relatively unscathed. And also when it comes to Basel II, we were even way ahead of that when it came to capital adequacy ratios and, of course, in terms of leverage as well. How does the rest of the continent look at this stage? Because we know that Nigerian banks in particular have gone through a very tough time, and a lot of banks have been bailed out in that country.
Yeah, very good question. I think, fairly ironically, my own assessment and belief is that African banks and, the tier one Nigerian banks in particular are actually a very better placed position for Basel III than Basel II. Why do I say that? First of all, you got to look at African banks, and the large banks in Africa has always had very high liquidity ratios. Because of the capital markets and the interbank system is not as advanced there, banks have been running pretty large capital ratios. In the countries like Nigeria, for instance, the minimum liquidity ratio for banks is 25%, which is quite large. Now, you never had a liquidity requirement under Basel II in an international regulation, and that's a new requirement, which will not, under Basel III, which will not really negatively impact Nigerian banks and for that matter, I think the top tier one banks across the continent. Secondly, you have under Basel III a much more restricted definition of capital. Hybrid instruments, convertible, debt equity convertible type instruments, etc. These do not qualify for capital under Basel III anymore. Now again, you look at banks across Africa, tier one banks, and for that matter, the tier one banks in Nigeria, they don't have these type of instruments in a capital structure. They're very simple, tangible net worth, paid up capital, shareholders funds, tier one capital, 100% of the capital structure is basically tier one. The third point is that what Basel II also recognizes that the credit risk of the trading and derivative activities need to be capitalized at a lot higher level than before. So these new requirements for the capital requirements in the trading book is not really going to impact negatively on Nigerian banks or banks across Africa, because simply they don't really have derivative business. They have very small proprietary trading, and the treasury business is fairly simple cash spot type transactions.
Well, Andre,
the last reason,
please complete that.
The last reason, is that Basel III has got this leverage ratio. I think the other guys alluded to that. Is that you can only leverage your capital up to a certain factor. Now, the capital ratios of large banks in Nigeria and elsewhere in Africa were pretty high. These leverage ratios are pretty much in line with the way they capitalize in any way. So yes, one can never generalize in any of these sort of rules, but my own assessment is it would in fact not be. I would think that Basel II would have been more negatively impacted on some of the Nigerian banks and also in Africa and in Basel III.
Well, Andre, if we're going to be seeing these banks have higher liquidity ratios, do you think that it perhaps will make them think twice in terms of the credit allocation, going forward? Perhaps it's already tough in Africa to get credits, and we know as consumers we pay a relatively high rate in comparison to the developed world, and it's not so much about what we've been seeing in South Africa, but in Nigeria and Kenya and in various other African countries. Do you think that this could perhaps tighten their purses even further?
No, I don't think so. As I said, the reasons why credit extension by credit providers in Africa is not that aggressive is simply because of the risk involved. You have infrastructural issues. You have legal environments, it's difficult to recover debt, etc. So all of these factors really has restricted lending to a large extent. I don't believe that the liquidity requirements, because as I said, banks already in Nigeria and elsewhere have a very high liquidity ratio. They're fairly well capitalized, fairly high capital adequacy ratios and so forth. I think it's rather the political, economic environment, infrastructural challenges that need to be addressed, the legal system, political risk, as these factors are getting more benign and more conducive to lending, banks will lend in Africa.
Frank, looking at all the noise that has been happening, it's not only about the developed world, it's also about having one rule for everyone. Do you think that we should differentiate what we've been seeing in emerging markets and the developed world? Because during the crisis, we saw a massive decoupling occurring when it came to the banking sector.
I think one can make that argument, but on the other side, the legislation here is to put everyone in the same boat. And I think what Andre has mentioned quite correctly is because the degree of sophistication often was lacking in some African banks to determine their credit levels, etc., they tended to overcapitalize themselves and keep too much liquidity in the market. On the other hand, they also probably didn't have the derivative dealings that we saw largely in Europe and the US. So they didn't have that problem either to a large degree. And so I don't think we would need that in order to not be disadvantaged by the legislation, because I don't think the legislation will disadvantage us in the end.
Okay, Andre, give us your view on the Nigerian banks, because, I've mentioned it before, we have seen massive bailouts for a lot of the banks in Nigeria, but you're talking about them being relatively well capitalized. I find a massive disconnect there. Also, just give us your view on the fact that, Basel III and Basel itself talking about the separation of assets. So in other words, investments versus the deposits themselves. Do you think that that would be a good move? Because this is one of the big reasons that Nigerian banks came under pressure.
Yes, yeah. Look, in terms of the capital, really, you can never generalize in anything. If you look at internationally, there were very good banks that were very well capitalized and ran into major problems with the global crisis. So I think in general, it depends. The level of capital is not really, is never a gauge of how well a bank is capitalized. It's all a relative game. Yeah, you can have a capital adequacy ratio of 30%, but very high risk in your loan book and might end up not being adequately capitalized for the risk that you have. You might have a capital adequacy ratio of 15% and end up being adequately capitalized for the risk. Clearly, the Nigerian banks that ran into problems, there were a lot of issues. I mean, these are not new. They related to loan quality, also to corporate governance, and primarily to corporate governance issues, probably more than anything else. Failures in the risk management, certainly. The capital market problem, where banks extended loans to stockbrokers, etc., to take positions in the capital market, and the collapse of the capital market had a knock-on effect, etc. So I think you've got to distinguish, and clearly the tier one banks that are strong and is still continuing and growing their business through this crisis. Are fairly well capitalized in Nigeria compared to international standards.
Okay, so what is your view on separating assets, deposits versus investment assets as well?
Yeah, like that initiative, the Central Bank of Nigeria has got a holdco, or has put in a regulation, draft regulation that is in the process of going through getting on the statute books now. What that will lead up to is the change of the old universal banking model that you have currently in Nigeria. Quite clearly, as you say, banks in Nigeria are on the universal banking model, and currently, they have many banks and non-bank related type activities. Under the new set of rules that the CBN is working towards, you'll have a bank and a bank holding company. You will have non-bank financial services, but that will be restricted to certain type of financial services, and all of those activities need to be adequately capitalized at the individual entity level, and then at the holdco level you also need to be adequately capitalized. So I think the CBN has actually taken already the steps in the right direction to address this whole problem going forward.
Frank, looking at Basel as a whole, do you think it's a step in the right direction? Because clearly we don't want to go through the same troubles that we went through with the debt burden on these big banks.
No, absolutely. And I think in the defense is, this was a unique combination of events that culminated in what we're seeing now. I think the reasons for the failure of the banking system were so diffuse and from various issues, and there were a lot of parties that played a role in where we find ourselves these days, that something had to be done. And that something wasn't just amendments or adjustments to Basel II, it was a rethink of the weaknesses of Basel II, and I think that is definitely going to come through in this new piece of regulation.
Andre, just very, very quickly, your final views on Basel III as it stands right now. Do you think it's a step in the right direction?
Yes, it's certainly a step in the right direction. Although, personally I'm concerned. I believe it's a knee-jerk reaction. It's the worst time to write this type of regulation is just after a crisis, because there's political interference. You've got to remember that regulators is under a lot of pressure now to come up with something drastically. And in such situations, you get a set of rules that's not so well thought out. I mean, we saw what happened in the US with the Glass-Steagall legislation that came in after the collapse in Wall Street in 1929. That was actually very, very bad for the American system. It took about 70, 80 years to get it off again, and now we've got a second set of regulation that is also fairly draconian being. So personally, I'm concerned. I think the impact on the global economy will be quite negative. If you look at the numbers, the capital requirements in the system will increase drastically. Yes, it's a good thing. The system need to be adequately capitalized, to prevent this type of crisis going forward. But you also sit in a situation where world economy is pretty weak still. I don't think we've seen the end of the economic weakness yet. There's talks of a double depreciation, etc. So it's a step in the right direction. I would personally favor a more gradual implementation of the rules over a longer period rather than a big bang.
Thank you, Andre.